I think it's important, even as you think about constructing your own team and how you run operations internally, to think about how AI can be used to help expedite things that might have historically taken longer. And so I think one trend we're starting to see is these very small, lean teams leveraging AI to build big businesses with what historically might have taken 40, 50 people, and they're 10 people or less. So that's a reality that we're continuing to see, is highly efficient teams leveraging AI.
Welcome to another episode of Business Ninjas. I'm here with Isabelle Tashima from Volition Capital, and really excited for this conversation. Hey, Isabelle, how's it going?
Good. Thanks for having me.
Yeah, my pleasure. So Isabelle is an investor at Volition Capital, and I thought this would be a great conversation for anybody listening to learn a little bit more about what Volition Capital does, and Isabelle, what you do as an investor. So why don't we just start from the top and just tell us a little bit about what your role is at Volition Capital and what you typically do, and maybe what a day in the life looks like for you.
Yeah, so I joined Volition Capital about a year and a half ago out of business school. We are a growth equity firm based in Boston. We've been around for about 15 years now. The origin of the firm was that we spun out of Fidelity back in 2010. Now fully independent from Fidelity, we're on our fifth fund. It's a $675 million fund, actively making investments in that growth stage. So we're not an early stage venture firm. We tend to participate most often at the Series A, Series B mark, and we will write checks anywhere in the $20 to $60 million range. So we look to take pretty significant minority positions in companies that have found product market fit. For us, that means, they have a product that's real. They have customers that love it. We say in the 5 to 50 million of revenue range, and have historically been very capital efficient. A lot of the companies we invest in have raised very minimal outside capital. A lot of them have raised no outside capital. So it's really about, doing a lot with a little, finding product market fit, and being ready for that next stage of growth. So that's where we come in, and we partner with companies across industries, both B2B and B2C. So I tend to spend a lot more of my time on the B2C side, looking at high volume transactional businesses. And then we also have a software team that does sort of your B2B enterprise SaaS as well. So from a day-to-day perspective, we're talking to companies all the time, getting on the phone, understanding their business, asking questions, trying to figure out if we could be a good fit as a partner to support that next stage of growth. And then from a portfolio standpoint, we really take a more concentrated approach to our portfolio construction. So the idea is that every company we choose to partner with, they really feel like they're a portfolio of one. And even though our fund is $675 million, we might only invest in anywhere between 15 and 20 companies. So the idea is that we try to be an active partner. We're really there for the long term, very founder friendly, and try to support companies in any way that we can to be that partner as they scale into the next stage.
That's great. And is there a common thread with the companies that you invest in? Like sometimes where there's a common thread, you can get this sort of collective knowledge or collective strategic advantage or buying power or some sort of other benefits that you can bring to your portfolio companies that gives them a competitive advantage. Tell me a little bit about your thoughts on that.
Yeah, I would say we are truly a generalist firm. So we don't take a siloed approach to how we construct the portfolio from an industry perspective. That means that we're looking for the best opportunities in whatever industry that might be. So we're flexible across industries, verticals, and business models. That means that naturally we've built expertise in certain industries. And as we think about continuing to deploy the rest of this fund, there's obviously synergies that we can apply as we think about some of those verticals that we have expertise in or have had success in, and that can be relevant. But at its core, I would say we're looking for companies that have strong fundamentals. They've done a lot with a little. They found product market fit. They have a repeatable acquisition motion, and they're ready to scale that.
Makes
We
sense.
found other ways, I think, also to add value to our portfolio companies beyond just building expertise in one industry. So we've built out a portfolio operations team that will help support our portfolio companies with everything from hiring to marketing to strategy to finance. And those resources come along with our investment. So we try to think about it as, okay, how can we be partners and provide value beyond just the capital going to the balance sheet? It's about being a partner. It's about supporting wherever we can, bringing in those resources should they be relevant, and bringing more to the table beyond just cash in the bank.
Yeah, that's great. That you're now a strategic investor at that point, and you're helping to pull on the rope. So that's really cool. Let's maybe start from the top and tell me a little bit about your background. How did you even get into this? What where did you grow up? What was some of your first experiences getting into entrepreneurship and investing? I always love the story behind how people got to where they are. So tell me a little bit about that.
I'm originally from Chicago. I did my undergrad here in the Boston area. Didn't really know what I wanted to do, but I grew up playing sports. It was a big part of my life through college as well. I think through that, I learned I want to be a part of a team. I want to work toward a bigger goal. Taught me a lot about work ethic, taught me a lot about consistency, and how consistency can compound over time, and started to get curious about businesses, why people make decisions, both consumers and other businesses, and decided to minor in psychology during my undergrad. And through that, I think that led me to asking more questions about businesses. Why do some succeed? Why do some fail? Why does someone choose to buy a product? Why does someone not? And from there, out of undergrad, I joined Goldman. I worked on their middle market M&A team in the investment banking division. It was an exciting place, exciting time. Worked with a lot of founder-owned companies, sort of at the end of their journey when they're looking to fully exit or sell the company, which was great from a fundamental perspective. Learned about capital markets, learned about what that exit ultimately looks like for a lot of founders. But through that experience, learned that I want to be a part of the journey for longer. I want to be a part of what it's like to build the company from 0 to 500 million in revenue. And all the roadblocks and the hurdles that come along with that, I want to be a part of those conversations. So from there, didn't know exactly what type of firm, what type of stage, whether it was venture, whether it was growth, whether it was PE. So I went to business school at MIT, again, back here in the Cambridge area. And one of our managing partners here at Volition was actually a guest speaker in one of my classes about scaling ventures. And he presented the case study of why Volition invested in Chewy, the pet company. We were their first investor. And that was a company that tons of other investors had passed on. And he explained Volition's more contrarian approach to maybe looking where other investors aren't looking, or looking beyond some of the reasons that a lot of investors would initially pass. And I thought that was really interesting. And so after hearing him speak, I joined Volition right out of business school.
That's great. I'm so interested in the Chewy story. I used to be an entrepreneur in residence at Idea Lab, and at Idea Lab, they started pets.com, which didn't go as you probably know. So what was compelling about Chewy at the beginning when Volition first invested in the company, and what were some of the levers that were pulled that really made it successful?
Yeah, it's a good question, and obviously was an awesome outcome for the firm. Back at the time we invested, it was an extremely low margin business in a category that was unattractive to the broader market. It was the pet space before the pet space was cool. It was low tech. It was boring. There wasn't much happening in that space. combined with a very low gross margin business. So there were very valid reasons that other investors had passed. I think what we saw was this is a category ripe for innovation. And underneath it are customers that are incredibly loyal, incredibly sticky. They're willing to spend on their pets despite what's going on in the macro markets. And Chewy was incredibly customer obsessed. They were obsessed with the customer experience. They were obsessed with delivering the best customer experience relative to anybody else in the space. And that, I think, was their best differentiator. And I think a lot of founders out there it can be easy to try to optimize for growth at all costs. Let's grow as fast as we can. Let's show everybody our headline metrics. But oftentimes, if it's not in a thoughtful way, it can come at the expense of customer experience. And in that case, the growth might not be that durable. And so sometimes there's companies that we look at that other investors might pass because they're not growing 200% year over year, but they have strong fundamentals. Their existing customers love them, and they're customer obsessed. So I think that was one of Chewy's big differentiators.
It's really interesting. And I love how it, pulls forward into opportunities that you're evaluating today. So let's dig into that a little bit, because I'm such a fan of anybody who's really focused on being obsessed with the customer experience, because it's just so important. Everybody says that they're obsessed with customer experience, but others, do it better than some. How do you peel that back when you start looking at a company and you're digging into, they've got great fundamentals, they show you all the good stuff. At some point, there's like the good, the bad, the ugly, and you really have to kind of peel it back and look at objectively how that business is operating. What are some questions that you ask? How do you peel that back, and how do you kind of surface up, what's really happening with a company to get the true story so that you can make a decision, yes or no?
Definitely. We want to invest in companies that have a product that customers love. And so I think at the highest level, an easy way to think about it is, has your customer become your marketer? So where is growth coming from? A lot of the companies that we invest in, it's pretty organic. There's a lot of referrals happening. There's a lot of word of mouth. And I think oftentimes founders can underestimate the impact of brand. So if people are talking about your company and you're building a brand, you're building a community, that can really accelerate the growth flywheel. So understanding where growth is coming from can be step one.
Mm-hmm.
From a metrics perspective, we'll often look at retention to understand, are customers leaving? How often are they leaving? If they're not leaving, and if they're staying, are they expanding? Because that can often be evidence that they like the product and that it works.
Yeah.
So I think those are great places to start. But we often see companies at this stage really start taking off just based on word of mouth and referral. And that can be evidence that they found a seam in the market and their product is solving a real problem.
Yeah, it's interesting looking at, churn and negative churn, right? And then talk about this viral coefficient kind of concept. It's a venture capital kind of term, but for anybody that's listening, these are drivers for businesses, and what makes a company either a rocket ship or maybe just something less than that. How do you guys look at that?
It's an interesting question. And I think as the entire landscape of go-to-market and go-to-market channels continues to change, that virality sort of coefficient has become even more important. You're seeing a lot of companies that traditionally relied on legacy paid channels, Google, Meta, etc. And now there's an opening in the market for social, for community, for leveraging creators. And that can drive also organic traffic around your brand and help accelerate that sort of virality coefficient that can really drive growth. And so some of our best companies have actually moved away from relying on these paid channels, especially within the consumer lens. And and have doubled down on building community on platforms like Reddit, like X, being really in tune with the customer, and then also leveraging people that will organically drive UGC content, that will talk about your brand on socials. And that can have a much greater outsized impact as the entire landscape of go-to-market is sort of continuing to evolve. So it's been interesting. I think it's more important than ever to continue to think about how to optimize go-to-market, especially as you enter the next stage of growth. It's pretty essential that you have a repeatable strategy around it.
Yeah, I love that. And I love this concept of like in our discussion here, we're starting to get down to the street level, right? Of like, here's what makes you invest in it, and this is why. But if you get down to the street level, you guys are looking at a lot of different companies, and I'd love to just talk a little bit about some of the actual tactics that you see working. You know, when you say building community, kind of know what you're talking about there, but are there certain tactics or certain things that, you know, if you were to, you know, advise a good friend or family member of like, you know, if you really want to accelerate the growth of your business, these are some dials to turn and focus on. Anybody who's listening this is gold. So would love to just kind of get some ideas of what you see is actually working to build that community, or maybe some tactics that you find effective.
Yeah, I think you have to think about what problem is your product or service solving, and
Mm-hmm.
who does that resonate with? And so that goes back to understanding your customer, because if you can find something that resonates with a specific subsegment of the market and then build a community around that, whether it's through leveraging socials, whether it's through in-person events, whether it's through branding campaigns, that's where you start to drive the flywheel. And so I think understanding, who am I selling to? Where does my problem resonate? What's working and what's not working? And so picking apart go to market from a channel perspective to understand where my customers are coming from, where is growth coming from, and how do I optimize that for the next stage, I think can be very, very helpful. And I think it comes back to always being close to the customer, making sure you're getting that feedback. And we actually met with a company a couple months ago where the CEO, for any new customer that spent above a certain amount on their first order, he sent that customer a Zoom link and got on the phone with them to understand what their intent was, how they found them, what their goals are, any feedback. And I think from day one, that can be the easiest way to start building a community and to continue from a product improvement perspective as well.
Yeah, that's great. And that's really, you know, just that tactic alone is so important, because you start to really develop a relationship from the top of the company to the customer. When a customer is talking to the CEO of a company that they already love, it becomes this, it's like a reward for the customer. They get to,
Yeah.
you know, meet the top person who's driving it, and potentially influence how the company, you know, shapes their go-to-market from there. Yeah.
It's all about trust. It's about building trust with the customer and building loyalty. And if you have those two things, they're much less likely to churn. So
Right. Yeah, really cool. What are there any other tactics that you think are that kind of stand out as you're meeting with, you know, companies, and kind of seeing any kind of patterns or trends of how they build community, or how they kind of harness, or maybe even some tools that they use that are effective?
definitely, I would say social. It's essential to be using socials.
Yeah.
If you aren't, you're behind. Um, and so we actually recently invested in a company called Statosphere that helps brands, and mainly in the CPG space, but scale influencer campaigns, and especially focused on micro creators, nano creators. And so historically, I feel like a lot of brands and companies thought about this space and about sort of the influencer marketing channel as we have to spend six figures on these super large influencers to talk about our company, and hopefully we'll get a few conversions, but we don't really know what engagement looks like.
Yeah.
And now you're seeing this trend of commercial power shifting down market to these smaller creators that have very engaged communities.
Mhm.
Um, And so maybe they only have 5,000 followers, but all 5,000 of those followers are within a target demographic, within a target subsegment, and are all going to see that video, and likely all or a large percentage will convert. And so I think it's about understanding how you can use channels to most effectively leverage engaged communities, because there's something to be said about getting your brand name out to as many people as possible. But if they're not the right people, if they're not your target customer, then maybe it's not as effective as you think. And so thinking about engagement, I think, is really important as you try to build community as well.
Yeah, and how that ties to actual cost of acquisition, right? And running various different tests. One of the things that we like to do is look at YouTube channels of who's got audience, but they don't have ads in their videos. Reach out to them, and a lot of times you can buy inefficient media simply by just doing a good job of reaching out to people who have a large audience, relevant audience to what you're selling, and get your message in front of those people. Do you see stuff like that? Are those tactics that your companies look at?
I think measurement and understanding data across different channels is becoming incredibly more important. So you're not just spending money on the channel and hoping that you're reaching the right people. You actually know who exactly you're targeting, and that if you buy an ad placement, it's going to the right people, or it's going to a certain demographic. It's going to a certain type of customer or user. So I think it's becoming incredibly more important as the number of channels are increasing and the number of platforms are increasing and the ways that you can reach people are increasing to make sure that you're paying attention to the data around it as well. And from an investing perspective, it's definitely opening up the market from an innovation perspective. And there's companies entering the space with the capabilities to pull this data across platforms at a very granular level. So it's been interesting to see it unfold.
Very cool. Let's bump up a notch, and let's talk a little bit about the journey from the first meeting to an investment. I'm sure you guys get hit up a lot for taking a first meeting, and there's obvious qualification that happens within that. And then they have your first meeting, you have your first meeting with them, and then, obviously there's a funnel to get to the investments. Talk a little bit about that. What does that all look like? Demystify the investment process a little bit. I think people find that really interesting.
A lot of the investments that we end up making start with a simple first call, where we'll get on a Zoom or meet in person, and it's really just understanding, what does the company do? What problem are they solving? What has the founder's journey been? Why did they start the company? And where are they today? So understanding if we can be a fit is usually the intent of the first meeting from both sides of it. From a founder perspective, there's a lot of investors that just won't be the right fit for your company. So in that first meeting, I think it can be very important to, from the founder's perspective, tell the story very concisely. Here's where we are. This is the problem we solve. This is the seam we saw in the market. And this is where we're taking the business. And from there, you can probably figure out very quickly whether the investor on the other side is going to be a good fit to continue the conversation or not.
Yeah.
So that first meeting, it's just about understanding fit. And then from there, if a company is a good fit for us, we typically dig a layer deeper and start to sort of peel the layers open, and we'll request some data, and we try to do all the diligence we need to do in terms of understanding some of those metrics that we discussed earlier. So at a high level, understanding, how fast is the company growing? Where are they today? What is the margin structure of the business? Are they burning cash? Are they profitable? Where are they acquiring customers? Is there channel concentration? What does retention look like? And do we feel like there's enough of a repeatable motion to underwrite what this company might look like in 5 to 10 years? So those are the things that we try to do within our diligence period. And then ideally we get to a term sheet. And from there, it's just confirmatory diligence, which takes around a month. So I would say the whole process for us is about 2 months on average.
That's great. That's pretty fast. And for an entrepreneur, that's incredible because obviously they got to run their business while they're putting this deal together.
Right.
So got to make sure that the wheels stay on while they're doing this. Um,
Right.
yeah, that's really interesting that it takes, that short of a period of time to go from, hello to let's go.
I think part of that
Yeah.
is a function of the fact that we are very conviction driven here.
Hmm.
So there are some firms that they'll have a unanimous investment committee. Everybody has to vote. And if you don't have everybody vote yes, then a deal can't proceed forward. And we were built on the idea that we want everybody in this firm to be able to move forward with the deal if they have conviction about it. And so it allows us to move quickly, but it also allows us to maybe think a little bit differently, a little bit more contrarian. Maybe one partner sees something that the other partner doesn't. And so I think some of our best deals have been fallen in that camp that maybe one person would have passed on, but somebody else saw something exceptional.
Yeah. And how big is that board that is evaluating the opportunities?
We look at every opportunity as a full investment team,
How
which
big is the
is
team?
pretty
Yeah.
unique.
How many people?
There's about 30 of us, 25
Hmm.
to 30 of us.
And when you're evaluating an opportunity, is it common for that founding team to meet all 30 people, or is that part of the process? Like, come on over, let's all meet, or is it really you have a champion who's championing the deal, and they're kind of the spokesperson internally to that group?
If possible, assuming that travel is possible and works out for everybody, we typically have the founders come in person and present to our team, the
Hmm.
full investment team. And if it's not possible, we'll usually do it on Zoom.
Yeah.
But everybody is looped into every deal, and I think that's important because people can raise things that maybe the deal team didn't think about. Um, but as a deal team, we'll always spend time with the team in person as well outside of that.
That's great. How many deals do y'all do a year, or what does that kind of roadmap look like?
So the current fund is 675 million, and we'll probably do about um, probably 15 to 20 deals.
Hmm.
And so I would say you could call it 5 to 10 deals a year.
Yeah.
It's often not super linear, and sometimes
Yeah.
you'll have no
It's
investment for a
opportunity.
couple of months, and then you'll have a few at once. So um, on average, that's typically how it plays out.
Makes sense. Makes sense. And so, let's talk a little bit about entrepreneurship and founder qualities. When you meet somebody and they've got a great business and they've got a great team, what is the difference between good and great, and how do you guys evaluate that, and what are you looking for in terms of those founder qualities?
It's a good question. I think as you think about the spectrum of investing, early stage investing is often entirely or majority qualitative based because sometimes the companies are pre-product, pre-revenue. You don't have very many metrics to go off of. And so it becomes very much about who is the team that we're backing? What is the vision for the company? What market are they in? As you move toward the spectrum of later stage sort of growth or private equity on the farther end of the spectrum, it becomes more and more metrics driven because more data is available.
Mhm.
Where we sit in the middle, we try to balance both those qualitative factors and the quantitative factors. Obviously, there's a level of diligence we do on the quantitative side to understand, is this a good fit for us? What do the fundamentals of the business look like? All the metrics that I mentioned earlier. However, the qualitative side is still just as important to us, if not more important, as you think about who you're getting into business with. These are long-term partnerships. So we are looking to be a partner for 5, 10 years. And so who we choose to partner with from a founder perspective, from a team perspective, is incredibly important to us because at the end of the day, we're hoping to invest behind and partner with category defining businesses. So we're looking for founders with big visions that are, again, customer obsessed, that have a goal to make, not just a lifestyle business that they run on the side, but this is their entire livelihood. This is their life. This is, they're putting everything they have toward this. And so, we're looking for those types of founders. And oftentimes it's hard to put it, sort of pinpoint it, because it's pretty intangible, but we try to marry both the qualitative and the quantitative parts of thinking about the investment more holistically.
Yeah, yeah. And it's really interesting when you have that kind of long view on an investment. Obviously, we're in the world of AI these days, and some companies are leveraging AI better than others. Are you seeing any trends? Are you seeing any kind of interesting ways that people are using AI to get that multiplier effect?
Definitely.
Talk
At
about
this
that. I'm
point,
so curious.
yeah, at this point, AI is table stakes. Everybody's using AI. If you're not using AI, you will be replaced by somebody using AI. So, it's expected that you'll be using AI in some capacity. Now, that doesn't mean that we're only looking to invest in sort of these AI native businesses, but I think it's important, even as you think about constructing your own team and how you run operations internally, to think about how AI can be used to help expedite things that might have historically taken longer. And so I think one trend we're starting to see is these very small, lean teams leveraging AI to build big businesses with what historically might have taken 40, 50 people, and they're 10 people or less. So that's a reality that we're continuing to see, is highly efficient teams leveraging AI. And I think as you think about capital efficiency, which is a theme that matters to us a lot, companies are able to be much more capital efficient, which is definitely a trend that works in our favor, and I think is really interesting to see unfold.
Yeah, absolutely. And it's interesting how companies that are using it are able to leverage this platform effect in a different way. When you're using Claude Code or Lovable or Cursor or what have you, any of these kinds of tools, and really create a platform kind of service, especially for or solution for B2C is really interesting. Are you looking at specifically companies that are platform driven, or is it transaction volume driven, or because what are some of the drivers in this? I know that some venture capital firms only focus on platform companies. Others focus on a repeatable business, and obviously you want both. But is there any kind of special focus for you all when you look at a company?
We are business model agnostic, I would say. So we have a team that will focus solely on B2B enterprise SaaS. There you get these, usually longer term, high ACV, recurring contracts, which is great. And then my team, where I sit on the internet side, it is these higher volume transactional businesses, which to a lot of growth equity investors can feel scarier.
Mm-hmm.
I think part of the reason that is because consumer demand often changes very quickly and sometimes unexpectedly. But often companies in that space are operating within massive markets. So if you can choose the right one with the right fundamentals, with a capital efficient approach, often that have these strong word of mouth, organic acquisition motions, you can flywheel and grow very quickly. So I think our approach by combining both business models helps optimize portfolio construction. Not to say one is better than the other, but we do look at both types of business models.
Yeah. And given all of this, what are some of the things that excite you most? Like when you're looking at opportunities and you see something and you're like, that's got the spark right there. What are some of those things that you get fired up about?
It's a hard question. A lot of it is the intangible. It's like when you get on the phone with a founder and you just know like they are building something incredible, and I want to do business with that person. Sometimes it's that.
Yeah.
I would say at the highest level, it's, you get on the phone with the founder and they're solving a problem that you resonate with, and it shows up in the numbers.
Yeah.
And so we want to partner with founders solving those problems. They're at the forefront of where the market's moving and not just where the market's been. And I think that's where you start to build these very large category defining businesses, because maybe they're one step ahead. And so that's sort of how we think about it. But I think there is a big intangible component of that first call with a founder, and you just know, like, this is the one. So
Yeah. Yeah, that makes sense. And so I guess for just to kind of wrap up here, I mean, for somebody who's early in their career, they're curious about investing or they're curious about being an entrepreneur, what would you encourage people to focus on first and sort of like their North Star so that they can get, they can be a successful entrepreneur themselves?
I think for someone early in their career, I would say the best way to learn is to ask questions. Learning about how different businesses actually operate across industries, across business models, hardware, software, internet, consumer. Ask questions, talk to people, understand how decisions are made at the day-to-day level. But ultimately, a lot of investing is about judgment. It's about pattern recognition. And judgment, I think, comes from exposure, asking questions, learning, getting that pattern recognition, which comes over time. So I think I wouldn't say there's a specific path to getting into investing. I think it's that path that used to maybe be a little bit more clear of do investment banking, then move to the buy side. I think that's fundamentally changing. I think you can come into investing from having your own startup, from doing consulting. And I think that opens up the opportunity to just continue to be curious about the market rather than follow a specific path because you hope to end up here.
That's great. Well, this has been great, Isabelle. Thank you. Really appreciate it. For anybody that's interested, go to volition.com and check out their portfolio. Thanks so much, Isabelle. This has been really interesting.
Thanks for having me, Andy. This was great.
Yeah, my pleasure. All right. Thanks everybody for listening. We'll see you later.
Bye.
Bye.